Good afternoon. I think there might be some people filling up their taco plates, but I'm going to get started to be sure we leave plenty of time. I know many of you, some of you I don't, so I will start by introducing myself. I'm Elizabeth Jacobs. I'm a senior director here at Equitable Growth, and I have the great honor of hosting our monthly seminars, as you all know, because you got the invitation. Today we are hosting Jacob Robbins, who is a Ph.D. candidate in economics at Brown and also a junior fellow at Equitable Growth. I'll say a little bit more about that in a minute. Jake specializes in macroeconomics and monetary economics, and his current projects include investigating the macroeconomic implications of a rise in monopoly power, which we're going to hear more about today, as well as studying the role of secular stagnation in the U.S. economy. He has an MA in Econ from Brown, as well as a BA in Econ and Math from Dartmouth. And as I said, he is a junior fellow at Equitable Growth. I want to reiterate how excited we are to have him here. He's our inaugural junior fellow. That's a program we started last year and will be continuing going forward. We have a request for proposals that is live on our website for our academic grant making more generally, that if you have an academic affiliation of any sort, you should take a look. We fund work along the lines of Jake's, in addition to work in a number of other areas looking at the relationship between economic inequality and economic growth and stability. The junior fellow application for this next year, so starting this summer, is wrapped into the RFP application. So if you or your grad students or your friends are either in a late stage doctoral program or on your way towards a postdoc, we would be delighted to see your application and potentially have you here in residence at Equitable Growth. I'm sure that Jake would be happy to answer questions after his talk. One note about the talk before I turn it over to Jake. This is on the record. If any of you are press or if there are press watching, this talk is on the record, and we are live streaming the event on our event page, as well as on our YouTube channel. If your friends miss it, I think that means that they can watch it, or you can rewatch the talk many, many times to be sure that you miss not a single nugget. So I will turn it over to Jake. He's going to talk for about a half hour, 45 minutes, and we'll be sure to leave at least 15 minutes at the end for questions, and I'll let him tell you whether he's happy to be interrupted or whether you should hold your questions to the end. Without further ado, Jake.
So thank you so much for the introduction. I'm very excited to be here, to be at Equitable Growth, and to talk about the rise in monopoly profits in the US. Feel free to interrupt during the presentation if you have clarifying questions. Okay, and so the title of this is The Rise of Monopoly Power in the United States, Macroeconomic Implications. And this is joint work with two other economists at Brown, Gauti Egerton and Ella Getz-Wold. So our research is motivated by a series of macroeconomic puzzles. And it's a series of trends that have cropped up in the data over the past 30 years or so. And they're really puzzles, in particular from the point of view of individuals who feel that there's no monopoly power in the US and that there's perfect competition. Okay? So one of the goals of our research is going to be to try and understand these macroeconomic puzzles. And we hypothesize that the driving force between these trends, behind this new data, has been an increase in monopoly power in the US. So the first puzzle arises out of the work of Thomas Piketty. To paraphrase Piketty, wealth is back in the US. So the ratio of wealth to GDP has increased substantially over the past 40 years. I'm going to tell you exactly how we're going to measure wealth, but the blue line shows the ratio of wealth to GDP. And it was around 250% of GDP in 1980, and it's risen to around 400% of GDP in the present time. So wealth is measured in the financial accounts, and it's the market value of all stocks, bonds, and housing. So this has increased over the time period. The puzzle lies in the fact that we've accumulated this wealth despite historically low savings rates. It's kind of very well known that savings has been low in the US for a generation. People think that this is a big problem. Despite this these low savings rates, we've accumulated this massive amounts of wealth that people like Thomas Piketty and others are very concerned about. It's a little bit of a puzzle. What's also puzzling is that this wealth is not embodied in physical capital goods, in productive capital. If you look at the capital to output ratio instead of wealth, this is now the dotted line here. This has been fairly flat over the time period. So we've had a big buildup in market value of wealth, but actual physical capital hasn't moved at all. So what's going on here? Instead, this wealth was accumulated through capital gains. Okay? There's been large capital gains on the S&P 500 and the stock indexes over this time period. So this is how we've been able to kind of accumulate this wealth, but there hasn't been productive investment behind this. So the second puzzle, this is very related, that there's been an increase in Tobins Q over the time period. A Tobins Q is a measure of the valuation of corporations. And this is using data from the financial accounts. And essentially, it's a ratio, and the numerator of Tobins Q is the market value of equities, and the denominator is the value of the capital stock. And so if Tobins Q is high, it means that stocks are priced very high relative to the capital stock. And Tobins Q has increased substantially over the time period. So it's roughly tripled. So this is using data from the financial accounts, but you can also use data from public corporations, so stocks that are listed on the major exchanges. And we see a similar pattern as well. There's been a large increase in Tobins Q. So the reason why this is a puzzle is from the point of view of perfectly competitive markets, theory should tell us that Tobins Q should be 1 in the long run. Of course, what does the long run mean? Well, I think it's shorter than 40 years. And Tobins Q has been above 1 for about 40 years now. This makes no sense from the point of view of standard economic theory. So this is the second puzzle. So there's two parts to the third puzzle. It's kind of well known that interest rates have decreased over the time period. Interest rates of all different sorts, not just short-term interest rates like the federal funds rates, but also measures of corporate borrowing costs. And it's these interest rates that I'm going to concentrate on today. So there's two measures here of corporate borrowing costs. It's the average yields on corporate AAA bonds. This is the green line. So these are kind of very safe corporate bonds, but then you could also look at riskier assets such as BAA bonds. And here this is the orange line. And both of these show decreases over the time period. So interest rates have dropped. And so the interest rate is a measure of the marginal return of capital. Economic theory tells us that corporations should invest until the marginal revenue product of capital is equal to the interest rate that you face. So if you just look at this graph, this would suggest that the marginal return on capital should be decreasing. So if you look at financial data, this is what comes out of this. However, if you look at aggregate data, if you look at aggregate macroeconomic statistics, you can also calculate another measure of the return on capital. And that's this blue line. And I'll tell you exactly how we calculated this in a second. So this, if you look at the macroeconomic accounts and you calculate the return on capital, this shows roughly a constant average return, this blue line here. And this is in contrast to the return on capital that you get if you just look at interest rates, which shows a decline over the time period. So this average return on capital, it's a measure of the profitability of firms. And the exact formula is below. We use data from the financial accounts in the corporate sector. And the numerator is essentially the net operating income of corporations. It's income minus payments to labor minus depreciation. And the denominator is the value of the capital stock. So there's been a divergence between the average return on capital and the marginal return on capital. This fourth puzzle, it's kind of well known that the labor share has decreased over the time period. The labor share is the percentage of output that labor receives. So if a corporation gets $100 and the laborers receive 70 of the dollars, the labor share would be 70%. So the labor share was around 66% in 1980, the beginning of the sample. And as we see from the orange area plot, kind of the share of labor has decreased substantially. So it's actually decreased by about 6 percentage points.
What's the difference between the profit share and the capital share in your definition?
Yeah. So, yeah. I mean, so the decline in the labor share is kind of a puzzle in and of itself. I mean, there's a lot of people trying to understand it. But so a lot of people, they only distinguish between a labor share, which is very easy to measure, and then they measure the capital share as just the complement of the labor share. So 1 minus the labor share. But following in the work of Simon Barkai and some others, we can actually go ahead and try and directly measure this capital share in the data. So if we can get an estimate of capital income, which we do in the paper, we can go ahead and then estimate the capital share, and then we get kind of what the real puzzle is not only is the labor share declining, the capital share of income is also declining. And what's left is this residual share. This.
Essentially, what you mean by capital share is, I'm sorry, are you accepting question?
Yeah.
Just clarifying question.
Yeah, please.
What you're calling capital share is the neoclassical idea of a kind of market, rental rate on capital, like what capital would get if it was receiving an equilibrium rental rate in a competitive capital.
Yeah, precisely.
Right.
Yeah.
So then what you're calling profit share is the net extra or oligopolistic rents or something like that.
Yeah, exactly. So there's an increase in this residual share, and we actually interpret this as an increase in the profit share. And so this profit share was relatively small in 1980. It was almost 0. And it's actually growing quite substantially. And now it's about 17% of GDP. So the final puzzle, there's a lot of puzzles. Okay, I've already talked about that, how interest rates are very low and how Tobins Q is very high. And so standard economic theory would say that both of these things should cause investment to be very high. If interest rates are low, firms should be investing. If Tobins Q is high, firms should be investing. This is actually the opposite of what we see. Investment is kind of historically low, and it's been trending downwards over the time period. So this is a measure of net investment relative to net operating surplus. And there's been a downward trend over the time period, especially since the year 2000. So what's going on here? What do we think is happening? Well, we hypothesized that there's kind of a common force behind a lot of these trends. And that's been an increase in monopoly power in the US. So I'm going to give you 2 sources of evidence, which is highly suggestive that there actually has been an increase in this monopoly power. So the first source comes from industrial concentration. Essentially, within an industry, the biggest firms are taking a greater and greater proportion of the output. So what I have here is a measure of the revenue share of the 50 largest firms in an industry. This is data taken from the CEA. And in basically all industries, there's been an increase in the proportion of revenue that the 50 largest firms have received. So the biggest firms are taking a greater and greater portion of the revenue. They're becoming bigger and bigger. There's an increase in concentration. I can show you another measure of concentration. This is the Herfindahl index. It's just a summary statistic of how concentrated an industry is, and then we take a mean across the different industries. And once again, there's kind of an upward pattern of concentrations across a broad variety of industries. You might be thinking to yourself, maybe in your head, a story about big tech companies or something like that, but it's actually a lot more widespread across essentially most industries. There's been an increase in concentration. So this is kind of the first set of evidence that suggests that there's been an increase in monopoly power. There's been an increase in concentration. So there's a second set of evidence, and that's data and estimations of markups in the US. And so the markup is the ratio of what a firm charges, the price, to its marginal cost. And it's kind of a direct, it's a direct source of measuring monopoly power. If there's perfect competition, markups would be equal to 1, and there'd be no profits. If the firms have market power, they can charge price above marginal cost, and they can make profits. And so there's a recent paper by Jan de Loker and Eekhout that estimates markups in the US using techniques from industrial organization, and they find a large increase in markups since 1980. I mean, a really massive increase. I mean, almost a tripling of markups starting in 1980. So in our paper, we actually have a different way of estimating markups. So they use techniques from industrial organization and using microdata, but we can actually use macro data to estimate markups as well. Essentially, I talked about how we derived this profit share before, and under a variety of models, the level of profits in the economy is proportional to the level of markups in the economy. So we can back out the level of markups in the economy from this profit share using this aggregate macro data. And so we kind of see the formula for how we derive markups. I mean, it's very simple. Markup is equal to 1 over the converse of the profit share, so 1 over 1 minus the profit share. We saw before how we can estimate the profit share using aggregate data, and so we can back out a series for markups over the time period. These are the implied markups from the data.
Or is this just an elasticity of substitution that you're expecting?
No. So one of the nice things about this method is you do not need to have an estimate of the elasticity of substitution. Other methods you do. So with de Loker, you do need that. Yeah. With us, this is purely with macro. Just yeah. And so there's kind of we see an increase over the time period, not as big as the de Loker increase, which I mean I think that's just way too big. But and we do see an increase. They're around 1 in 1980, which suggests that markups were low, pure profits were low, but it increases substantially to about 1.2 in the present day.
So, Jacob, so the way you build these markups somehow rely on the assumption that the cost of borrowing is the real interest rate.
Yeah. So.
And so you rely on the assumption that basically firms borrow or finance the capital spending by paying the real interest rate, and so how the resulting markup is the difference between the profits they make and the interest they pay. Or is that the underlying assumption?
Precisely. I mean, you have to estimate capital income in order to get the profit share. And as you mentioned, in order to estimate capital income, you need to know the rental rate of capital, which is determined largely by the interest rate. So you're correct in that statement.
So I know this literature very well, and we work on the same topic. One of the problems I find with this approach is whether really the cost of borrowing is informative of the return to capital. I know that you mean the return to capital for you is different than the cost of borrowing, but is it really the cost of borrowing reflecting like the fundamental return to capital? This approach is somehow followed as well by the paper of Barkai, and I have some doubts about that approach, which of course results from the initial distinction between capital income or capital saving and profit.
No, I agree. I mean, this is I would say one strand of the evidence. I don't think it's perfect evidence. We're dealing with estimations and macro data. So I agree it's not perfect. Okay, so this is one part of the hypothesis. So we want to explain these 5 different puzzles. And so it actually turns out that the increase in monopoly power, it's not enough. Okay? What we also need is a decrease in interest rates and a decrease in R star. And so we think that there's actually been a decrease in the natural interest rate, and that this is actually crucial to explaining this fact number 3, or excuse me, puzzle number 3. The puzzle that the average return on capital was relatively constant while interest rates have decreased. So markups, if you think that firms have monopoly power, this markup would tend to drive up the measured average return on capital. But this isn't what we see in the data. We see a relatively constant average return on capital. So the only way to explain a constant measured average return on capital with an increase in monopoly power is if interest rates have been decreasing. So the two of these forces together can describe and they can explain what we see in the data. The decrease in interest rates is actually important quantitatively as well for some of the trends of investment in capital. Let's see how much time we have. 6. Okay. And so following some previous work, kind of in the secular stagnation literature, we're going to model this decreases in interest rates by they're being driven by changes in demographics and also the rate of productivity growth. So finally, this paper is really about kind of the macroeconomic implications of an increase in monopoly power. We really don't try and talk about what's driving this change in monopoly power. Maybe it's changes in technology. I just wanted to just put up a few graphs kind of with the hint of an idea about what's behind this. This graph shows the relationship between two variables. The dotted line is, once again, the Herfindahl index, which is an index of concentration. And the solid line is the number of Section 2 antitrust cases under the Sherman Antitrust Act.
Can you tell us what years we're looking at there?
Sorry. Yeah, so this is starting in 1981.
81. So
Yeah.
the spike there is 90.
Yeah.
Gee, what a surprise.
These are launched cases or finalized cases, or?
I don't know. I'll have to get back to you on that. I mean, obviously this is only suggestive evidence, but what I get out of this is that in the period in which concentration has been increasing, there's been very low level of antitrust activity or cases. This is kind of another graph in that same vein. This is the fraction of completed M&A deals. This is starting from 1979, so the same time period. And so, there's been an increase in mergers and acquisitions, and fewer and fewer of these deals are being broken up by the authorities. They're being completed more. I think antitrust may be one of the reasons behind this. There could be also other reasons, changes in technologies, superstar individuals, superstar firms. But this isn't really the purpose of this paper. I just wanted to give a little bit of evidence about that. Okay. So we have these new puzzles and facts, and we have a hypothesis about what's behind them. So now we want to try and test the hypothesis. And so we're going to build a quantitative model of the U.S. economy that's going to incorporate all of these factors. It's going to be able to explain the joint evolution of all of these facts. We're going to estimate how much markups have changed. I've actually already talked to you I've already talked about how we're going to do that. And then, using our model, we're going to insert into the model these changes in markups and see if we can match these 5 puzzles and trends that we actually see in the data. So the starting point of our model is kind of the basic neoclassical model. But existing models, they can't really explain some of the trends that we've talked about before. In existing models, there's no distinction between wealth and capital, between average and marginal returns, and Tobins Q can never be permanently above 1. So we're going to have to put in a few parsimonious elements that can kind of start to explain the data. In particular, we're going to add a general form of market power, okay, so very reduced form market power, which is actually going to nest a number of specific market structures. So monopolistic competition, Cournot, Bertrand competition, and monopoly. We're going to get rid of the free entry condition. This is kind of a philosophical point, but in a lot of models, there's a free entry condition which drives pure profits to 0. Or if there's monopolistic competition, it means that you can make profits, but only after kind of paying a fixed cost. We're going to get rid of this and allow pure profits to be permanently positive. Okay?
So if you don't have free entry, what determines the number for firms?
Nothing. As we have very basic firm dynamics. It's kind of not what we're trying to match, but I mean, we're just interested in a reduced form generation of market power. Yeah, you'll see it in a second. So there's going to be market power, there's going to be positive profits, and the pure profits of the firms are going to be traded. There's going to be an additional asset class. There's not just going to be physical capital, there's also going to be claims to the pure profits. And finally, we're going to have a structure in which the real interest rate can change. Okay, so I'm going to get into the details of the model now. I'm going to try and stay at a relatively high level. So there's two sectors. There's a final goods sector and there's intermediate goods. And the final goods sector, there's a unit mass of identical firms, and they produce according to this production function. So final output is produced with intermediate output, and then there's a multiplicative G function. There's an aggregate good, YT, and this is equal to the integral of all of the individual final goods. And since all of the firms are identical, we're going to concentrate on the symmetric equilibrium, so an equilibrium in which all of the firms produce the same amount. And so in this case, we can forget about talking about all the individual goods and just think about aggregate output YT and aggregate intermediate goods YTM.
So how do you have concentration increasing if all firms are identical?
So this is, here we go.
All right.
Yeah. So I mean, this is a very reduced form version of monopoly power. It's not microfounded, but it nests a number of microfounded models. So the crucial assumption in our model, okay, is that firms have a degree of monopoly power. And as you said, this is not microfounded. This is completely exogenous. This is me specifying that there is market power in the economy. So these markups, mu, are going to follow an AR1 process. So essentially, they're just going to be exogenously specified. And the long-run level of markups in the economy is equal to mu bar, this AR1 process. So given that there's pure profits and that markups are greater than 1, there's going to be aggregate profits in the economy. And that's going to be given according to this formula. So profits are directly proportional to the level of markups. Okay, so there's these pure profits, and I'm going to talk about how they're distributed for a second. So there may be some degree of bargaining power. So for example, if there's a strong union, or CEOs have some sort of power to maybe raise their own pay, they could actually get a proportion of the profits. Okay, that's kind of on the left. So some of the profits might go to unions if they have some sort of, or workers if they have bargaining power. But the rest of the profits, they go to the shareholders, okay? The owners of these final goods firms. And the degree of bargaining power, once again, very reduced form. We're just saying bargaining power is equal to this Greek term CT. We have very reduced form firm dynamics. These final good firms that are making the pure profits, they're not around forever. They actually have a probability of going out of business. There's firm exit a la Melitz 2003. There's just a constant probability of exit capital delta. There's also a constant probability of entry. So each period, the firms that go out of business are replaced by new firms.
What does that give us?
So you'll see in the next slide, but if really what these reduced form dynamics are giving us is going to allow us to exactly nest a number of important macro models. So I'm just showing you stuff in reduced form, but this is actually going to nest, I mean, a surprising amount of models. You know, monopolistic competition, Bertrand. So in particular, this is going to get us some of the models of Bilby, Gironi, and Melitz, 2008. I mean, kind of like standard workhorse. This is also going to get us Aghion and Howitt, some of the endogenous growth models. They all have entry and exit. Okay, asset pricing. So there are these pure profits in the economy, and we assume that these pure profits, they go to shareholders, and that these securities are bought and sold on the market, and they're priced. Okay? So the securities receive the dividends from the firms, DT, and these dividends come from the pure profits. And so we want to price these securities, and we can do so using just a standard asset pricing formula. The price of a security is equal to the discounted value of the dividends that it receives. And in this case, the dividends, the discount factor, MT, is the stochastic discount factor. There's actually an additional discount factor as well, and it's the fact that some of these firms go out of business. So this is this additional delta here. Yeah. Delta is the probability the firm goes out of business, or goes bankrupt. So the stochastic discount factor is going to be derived on the individual side in a second. So intermediate goods are produced according to a standard CES production function. So goods are produced using capital and labor. Okay, so now we can actually, we're at a point in which we can start to see the benefits of our reduced form model. We can start to try and see how our model is going to match the facts that we talked about. So we can define wealth in the economy as the market value of physical capital. This is the QT, KT. And then the value of the securities. That's the XT here. Remember, the securities have the rights to the pure profits. We can also define our measure of empirical Tobins Q as the ratio of wealth, so the value of the pure profits and the physical capital, to the value of the capital stock. So this is corresponding to how Tobins Q is measured in the data. And we can immediately see that the existence of these pure profits means that there can be a divergence between wealth and capital. If there's a positive level of pure profits in the economy, that means that the value of wealth can be greater than the value of the capital stock. It also means that there can be a permanent divergence of Q from a level of 1, because Q includes the rights to these pure profits. So because we have this kind of focus on asset pricing in this, we want to try and really, make sure that we're going to match the facts of asset pricing. So we kind of include a standard, I would say, a standard way that people in the finance literature try and match the equity premium. It's a little bit technical, but we want to try and get the asset pricing right. And so we include long-run productivity risk. And this is essentially making risk in the economy such that the asset pricing in the model economy matches the asset pricing in the actual economy. So on the individual side, there's kind of a standard Epstein's-in utility function. And the only, I would say, interesting thing is this D, which is in the utility function. It's an additional wedge between current and future utility. And so what we take this to be is a reduced form way of modeling factors that are going to affect the real interest rate. This is how we're going to mess around with the real interest rate in the model. Okay, I'm going to skip some of the technical details. And I'm going to start to just, first of all, how much time do I have? Let me see. 9. Maybe 5 minutes. Okay. Yeah. Okay. I just want to maybe just talk about how this model is going to work. What happens when markups increase in the model? Okay. So it's actually very straightforward to see what happens. If there's a permanent increase in markups, that means that dividends are going to be higher. There's higher profits, dividends are higher. If dividends are higher, that means that the value of securities is going to be higher. Okay? There's going to be an increase in wealth to output and also Tobins Q. These were two of our facts. Capital, what happens to capital? So there's an I think in two slides I'll get to that. There's also increase when profits increase. There's an increase in the profit share. and a corresponding decrease then in both the labor and the capital share. Once again, exactly what we saw in the data. There's an increase in the average return on capital. Okay? It actually turns out that roughly the average return on capital is equal to the interest rate plus the ratio of profits in the economy to the capital stock. So if profits go up, this average return is then going to go up. There's also a larger gap between the average return and the interest rate, which is also what we see.
So in some sense, the equity premium is increasing?
It is, yes.
Does that come from shocking the Epstein?
I could talk to you after about that. It's a little bit complicated. Okay, so finally, when there's a bigger markup, that means that there's an additional wedge in a firm's investment decision, right? They no longer invest until the marginal product of capital is equal to the interest rate. They invest until the marginal revenue product. So essentially, they demand less capital, okay? And that means that investment goes down and capital goes down. Also exactly what we saw in the data. So altogether now, just the increase in markups can actually explain a surprising amount of what we actually saw in the data. It can explain an increase in the profit share, an increase in wealth to income, increase in Tobins Q, increase in average return, decline in investment, decline in labor share, and a decline in capital share. So the one thing it doesn't quite get is actually the average return. It wasn't increasing in the data. It was roughly constant. So in order to explain that, this is really where the interest rates go in. If interest rates are decreasing, both of these forces together could explain the constant average return. So we have our model. Essentially what we do is we calibrate our model starting in 1970, kind of before all of these trends took place. And then we do a quantitative exercise, okay? We want to see how this increase in markups can actually quantitatively explain these trends, not just seeing the direction, but if we can get the magnitudes as well. So we calibrate the economy to 1970, and we use our estimate of how markups have changed that I talked about in the introduction. And we get the following result. Okay, I'm going to kind of skip over the details of the quantitative exercise. But this is what happens in our model when we change markups as much as we have estimated that they've changed. Okay? This is kind of the main result. So we compare what our model says should happen with the increase in markups to what the data says. So this is with just the change in markups only. So our model suggests that we roughly get the decline in the labor share, the decline in the capital share, the increase in the profit share, the increase in wealth to GDP. We're a little bit off on investment. We are way off on the average return. We're a little bit off on capital to output. Tobins Q, we're matching. I'm not going to talk about the equity premium for now. So we're getting there, but we're not quite all the way there. And once we add in the decrease in interest rates, then we get actually a little bit closer. So when we combine the change in markups with the change in interest rates, as you see in this kind of the first row here.
So is that just forcing the D parameter or whatever to change to make the 2% decline?
Yeah, so there's two things. Actually, we're changing productivity growth, which is affecting the interest rate, and we're also changing the D parameter. I mean, so this is...
But they're calibrated to achieve the 2%.
Exactly.
What else follows?
Yeah, precisely. Originally we actually did have an OLG model, like where we were endogenously producing this decrease in interest rates. It's just more complicated that way. So now we're doing a lot better once we change interest rates on the average return. So before we were missing it, and now we're right around. What actually happened was that it was relatively constant. And all of the other numbers look, surprisingly well. We're changing one thing which we estimated, the change in markups, and we're matching 6 macro series with only one estimated change in markups. And we did nothing in the calibration was chosen to try and match the change in the series as well. It's not something which is just a function of how we actually did the exercise. Okay, so what are some of the implications of this if actually there has been a large increase in monopoly power? So the first direct implication is that there should be a large effect on inequality, so both income and wealth inequality. Okay, so if there's an increase in markups, there's an increase in the profit share, and that means that workers get a lower percentage of income and the capitalists get a higher percentage of the income, the owners of equity capital. Since we know that in general the people that own stocks are the people in the upper ends of the distribution, this is going to tend to increase income inequality. So there's also an effect of wealth inequality. We've shown how these pure profits can actually generate massive increases in stock prices, massive returns. Once again, the people that own the stocks, that own the rights to these pure profits, they're getting the benefits, and this has contributed to an increase in wealth inequality. The second implication is on growth. So if there's an increase in markups, this is inefficient. Monopoly power is inefficient. There's now a wedge between the marginal product of capital and the rental rate. There's also a wedge between the wage and the marginal product of labor. This means that there's going to be lower capital in the economy and lower GDP, and also lower labor supply. There's also indirect costs of monopoly power. If you think about rent seeking, with political rent seeking, and also just corporations spending money on trying to cement their monopoly power by product differentiation or maybe spending on branding and advertising. Tax policy, just touch on this briefly. So economic theory says that it's actually a really good idea to tax pure profits, monopoly profits. But it's not such a good idea to tax capital income. So it's interesting is that even with relatively moderate levels of pure profits, it actually becomes optimal to tax business profits, especially when there's write-offs for interest deductibility and accelerated depreciation. There's also implications for income accounting and wealth accounting. So I think this research points in the direction that measuring the level of pure profits in the economy is of first order importance. There's also some other measurement issues in terms of how intangible capital is going to be counted in the capital stock as well. Okay. So that's what I have for you. I think we'll take questions now. Yeah.
Do you want to call on your own questions?
Yeah.
I'm happy to moderate.
Yeah, I can call.
So I think in your very last bullet point, you kind of covered that, but like the sort of like are sort of like competing, I guess, general hypothesis here that there's mismeasuring the capital stock. And so it seems like if I'm following through your model, like everything is going to hold if your markup really just represents a return on intangible capital or some sort of IT sort of thing too. Is that right?
What do you mean everything's going to hold?
So let's say
the facts you mean?
Yeah,
okay, yeah.
The facts as if they're we interpreted the facts as if we're measuring sort of like a classic monopoly power, but if we're measuring a new type of capital, IT capital or something like that, most of the facts are gonna continue to follow through. So it doesn't really distinguish between those two hypotheses.
Yeah. No. So this is, I didn't talk about it here in the actual paper. this is a big discussion. It could be the fact that there's just this very difficult to measure quote unquote intangible investment. But there's a problem with this hypothesis in that we actually are already capitalizing a lot of intangible investments. The national accounts, they already capitalize R&D, they already capitalize new intellectual products like movies, etc. In fact, if you look at the papers on intangible capital by Holton and Chikhale, they give us 3 categories of intangible capital. The first 2 categories are already included in our measure of the capital stock. And the only category which is not included is something which is called economic competencies. And the economic competencies is spending of firms on stuff like branding and product differentiation and advertising. So this, to me, is not intangible capital. This, to me, is firms spending in order to increase their market power. And so I guess I would say that it's kind of, to me, the intangible story is a little bit of a complementary hypothesis. I don't see it as replacing this hypothesis. To me, this is firms investing in their own market share. So I don't, yeah.
No, just so one comment first to this question. It's very difficult. I mean, you would need like huge increases in intangible capital to match the evolution of Tobins Q. And this literature that considered that explanation of the rise in Tobins Q was because of the rise in intangible capital was an explanation that some economists were supporting in the 90s. But given the huge rise in Tobins Q and all the evidence that we have about the increasing markups, then I think the most plausible explanation for this is. And also, we already are measuring intangible capital in an imperfect way. But, and I have a question for you, Jacob. So the model assumes that the evolution of the interest rate. So from the perspective of the explanation of how Tobins Q evolved and how markup changed, the interest rate is exogenous because you explained that through the evolution of demographics and like in your paper on secular stagnation.
Yeah.
Okay, so okay. That's that is to me like the puzzle that still needs to be solved in this literature. Why markups? Why returns to, for example, like pure the returns coming from pure profits are not somehow equalized to the returns to like the nominal interest rate. You know? So that is to me like the next step that this literature should cover. And it's very difficult. I've been trying to solve that, but it's not there. But yeah. So thank you.
Yeah. Thanks.
So you set up your model in contrast with the traditional neoclassical model.
Yeah.
Great improvement. But there's a large literature that's been looking at this for 60 or 70 years in what's known as heterodox or post-Keynesian economics. Just to pick one old example, in 1952, a fellow named Joseph Steindl published a book called Maturity and Stagnation in American Capitalism, and he had not exactly, but a very parallel hypothesis that increasing concentration led to higher profit markups, which led to stagnation through somewhat different channels than what you have. But so it would be really interesting to contrast what you're doing with that literature as well, and thinking about whether there's something you're adding that literature did not see, but the other way around, or there's some things that literature looked at that are not in this. So if I might just pursue that thought, I have 2 to 3 minutes, organizers will allow me. So this doesn't really trace through, that's more of a kind of income expenditure approach in some ways. It doesn't focus as much on the asset markets. That might be a weakness of it, but it might also be a strength. You know, sociologically, the households receiving the capital income and the profit income are probably largely the same. So it contributes to inequality through what would be identified as the same thing in any kind of survey. And so then that feeds into things like different marginal propensities to consume with the wealthy and workers. It feeds into investment through different channels. So for example, if you have an investment function that's not depending on the marginal product of capital, but looking at things like accelerator effects. So there will be a negative accelerator effect. If growth slows down, then firms naturally want to invest less. There are also financial constraints. It's a whole series of things. And Steindl had actually one interesting microeconomic idea, which was that investing less is a kind of strategic choice of the more oligopolistic, monopolistic firms to not lessen their monopoly position too much. They want to overinvest. They want to have too much capacity. You might make the market competitive again. You might have too much output. So I could spend hours on this. We should go have coffee sometime. But
I mean, I absolutely
There's huge literature on this, and there's so many parallels, but there are also really interesting differences. I'll just leave it.
Yeah. Great.
So one of the things you're trying to explain is the rising of wealth to capital ratio.
Mhm.
I wonder if there's any way to think about how that as implication for other trends in the model, like if there's more wealth that might push down the interest rate.
Yeah, actually, this is something that Ignacio, I think, was alluding to. I mean, we have in this model, yeah, I mean, I say we depart from the neoclassical, but I mean, we're still really bedded to it. We're just kind of twisting it in a few ways. I think, you know, I would like to get beyond that in some other ways. And what you just said, so with a representative agent, the interest rate, essentially nothing affects the interest rate except for a few small things. Once you get away from this, then everything affects the interest rate, which is, I think, is what reality is. And you're right, so this would have effects on the interest rate because this is an increase in the supply of assets, essentially. Yeah.
I will take this natural pause to actually end us right on time. If we can give a round of applause to Jake. And just really quickly, this is our last seminar for 2017, so we are delighted to have had you all here. Come back in, I think, January. We will have another round of exciting programming, but you can have your holidays off.